Imagine you are a central bank governor in charge of the nation's treasury. Every morning, you have to make a decision concerning the nation's destiny. What do we buy today to protect our wealth? For decades, the answer has been the same: U.S. Treasury bonds, the world's safest asset. But this morning, the numbers you see sober you up completely. U.S. debt has broken through $38.4 trillion, growing by $71,884 every second. Even more shocking is that for the first time in 29 years, global central banks have raised their gold reserve holdings to exceed U.S. Treasuries. What does this mean? It means the world's smartest financial experts are preparing for a reality they are unwilling to publicly admit. The U.S. government's promises may no longer be trustworthy. Gold has just broken through $4,800, and silver has also hit a historical high. This is not a speculative bubble. This is global wealth searching for a new safe haven. What we are witnessing is the largest transfer of wealth and financial system restructuring in human history. That decision in February 2022 changed everything. When the US and the West froze $300 billion of Russia's central bank reserves, they didn't know what button they had pressed. For decades, central banks followed an unwritten rule: sovereign reserves are sacred and inviolable. Even during the most intense periods of the Cold War, this red line was never crossed. But now that red line has been broken. China holds over $700 billion in U.S. debt. But from that moment on, policymakers in Beijing clearly knew this $700 billion is actually a hostage in Washington's hands. If a conflict were to occur in the Taiwan Strait tomorrow, this money would evaporate instantly. Data confirms the validity of this fear. China has continuously reduced its holdings of U.S. debt to the lowest level since 2008. But more importantly, there is a global awakening. Poland's central bank raised its gold reserve target from 20% to 30%, buying 67 tons of gold in the first 3 quarters of 2025. Kazakhstan bought 40 tons, and China's central bank has increased its gold holdings for 13 consecutive months. What is the deep logic behind this shift? It is a reevaluation of counterparty risk. Traditionally, when we talk about bond risk, we focus on credit risk, which is the risk that the borrower doesn't have the money to repay. U.S. Treasuries were considered zero risk because the U.S. can print money to repay debts. But now, a new type of risk has emerged: political risk, which is the risk that the U.S. has the money but refuses to repay. The emergence of this risk has completely overturned the fundamental assumptions of modern financial theory. What does $38.4 trillion actually mean? Let me give you a more shocking perspective. If you spent $1 million every day starting from the birth of Jesus for 2,026 consecutive years, your total spending would still be less than $1 trillion. The U.S. debt is 38 times that figure. Just 1 year after Trump retook office, U.S. debt increased by $2.25 trillion, setting a historical record for the first year of a presidential term. This growth rate means the U.S. government adds $1 trillion in debt every 100 days. Even more fatal is that the U.S. now spends over $1 trillion annually just on debt interest payments, breaking the trillion mark for the first time. Here is a critical mathematical problem. The U.S. government's total revenue for the 2025 fiscal year is about $4.8 trillion, of which $1 trillion is used to pay debt interest, accounting for about 21% of total revenue. Historical experience shows that when a country's debt interest exceeds 30% of fiscal revenue, it enters a debt trap, where newly borrowed money is mainly used to pay interest on old debt rather than investing in the future. The US is rapidly approaching this critical point. Even more terrifying is the effect of compound interest. If the interest rate remains at the 5% level, the $38.4 trillion in debt generates $1.92 trillion in interest annually. This means nearly half of the US government's revenue must be used to pay debt interest. In this situation, one must either drastically cut government spending, thereby triggering an economic recession, or print money to dilute the debt, thereby triggering hyperinflation. Economists in BRICS nations saw through this mathematical game long ago, so they chose to exit early. In 2025, international gold prices surged by 67%, breaking through $4,800, setting the largest annual increase since the 1979 oil crisis. But what drove gold prices this time was not retail panic, but the collective, rational choice of global central banks. Data from the World Gold Council shows that since the third quarter of 2020, global central banks have been net buyers of gold for 14 consecutive quarters, with annual purchases exceeding 1,000 tons for the past 3 years. Behind this gold buying spree lies a deep economic logic. Gold is the only reserve asset without counterparty risk. When you hold US debt, your wealth depends on the credit and political decisions of the US government. But gold does not rely on any government promises. It cannot be frozen, cannot be attacked, and cannot be politicized. Goldman Sachs has raised its 2026 target price for gold to the $4,000 to $5,000 range. JP Morgan predicts it will reach $4,500 by year-end. But these predictions might still be conservative. The key lies in understanding the driving force. This is not speculation, but a revaluation of the monetary credit system. When the dollar turns from a global public good into a geopolitical tool, the rational choice is to look for alternatives. More importantly, the historical relationship between gold and US debt is reversing. In the past, the proportion of gold in global central bank reserves was far lower than that of US debt. But in 2025, the proportion of gold reserves exceeded US debt for the first time, reaching 20%. This is the first reversal in 29 years, marking a fundamental restructuring of the global reserve system. Silver has also benefited from this rally, hitting a historical high. As the poor man's gold, silver's industrial demand, especially for solar energy and electronics, combined with monetary demand, forms a dual driving force. The explosion in silver prices is often more intense than that of gold, providing investors with another option. 50 years ago, the Petrodollar agreement reached between the United States and Saudi Arabia shaped the modern world. The agreement was simple. Saudi Arabia would only accept US dollars for oil payments, and the US would protect Saudi Arabia's security. This created artificial demand for the dollar, allowing the US to print money to buy the world. But this system is collapsing systematically. Saudi Arabia has begun accepting RMB for oil payments. Russia sells energy in rubles. Venezuela accepts gold payments, and Iran has established a barter system. More importantly, 99.1% of trade between Russia and China is now settled in local currencies. This is not an isolated case, but a trend. Let's look at the specific data. The dollar's share in global cross-border payments dropped from 49.7% in April 2025 to 46.9% in August, hitting the lowest level since February 2024. China's cross-border interbank payment system, known as CIPS, now connects 4,800 banks in 119 countries, with 1,467 participants. The impact of this change is exponential. The petrodollar system not only created demand for the dollar, but more importantly, established a dollar recycling mechanism. Other countries used dollars to buy oil. Oil exporters used dollars to buy U.S. debt, and the U.S. used the money from selling debt to continue printing money. Now, every link in this cycle is breaking. Trump's threat of 100% tariffs has actually accelerated this process. When you threaten others with tariffs, you are essentially telling them, find an alternative. This is exactly what countries are doing. We are witnessing the parallelization of financial infrastructure. For decades, the U.S. financial system acted like the root server of the internet. All international payments had to pass through it. But now, other countries are building their own networks. China's CIPS system now processes 175 trillion yuan in cross-border RMB payments, a year-on-year increase of 43%. Russia's SPFS, System for Transfer of Financial Messages, India's UPI, Unified Payments Interface, and ASEAN's newly announced local currency settlement plan are not experimental projects, but complete infrastructures replacing the SWIFT system. More importantly, these systems are starting to interconnect. Once network effects form, critical mass will be reached. By then, the world will have an international payment system completely independent of the United States. The impact of this disintermediation is revolutionary. It not only reduces demand for the dollar, but, more crucially, breaks the U.S. monopoly on global financial information flows. Digital currencies are also accelerating this process. Although there is no timetable yet for a common BRICS currency, the development of central bank digital currencies, or CBDCs, by various countries provides new tools to bypass the dollar system. China's digital yuan and Russia's digital ruble are both testing cross-border payment functions. Now let me tell you what all this means for the ordinary American. For 50 years, American consumers have enjoyed a huge hidden subsidy. The strong dollar allows you to buy global goods at low prices, with the underlying costs borne by other countries. Specifically, you can spend $800 for the latest smartphone, $25 for a pair of decent quality jeans, and $3 for a Starbucks coffee. These prices are artificially suppressed. The suppressed costs are borne by countries that accept dollars and then buy U.S. debt. They are effectively subsidizing your lifestyle, but this subsidy is disappearing. As more trade bypasses dollar settlement, demand for the dollar falls, and the dollar's purchasing power will also decline. If the dollar depreciates by 20% against the currencies of major trading partners, then an $800 smartphone becomes $1,200, $25 jeans become $40, and a $3 coffee becomes $5. Prices for imported cars, electronics, and clothing will all rise across the board. This is not ordinary inflation, but a structural repricing. The low prices you enjoyed in the past were a privilege built on the foundation of dollar hegemony, and now this privilege is being stripped away. Even more serious is the impact on employment. When the U.S. can no longer purchase global goods by printing money, the trade deficit must shrink. This means fewer imports, but at the same time, export competitiveness also declines because the dollar remains relatively overvalued. The result is a reduction in job opportunities, particularly in the service sector. Here is a brutal truth. Substantial interest rate cuts may never come. The reason is simple. The U.S. government needs to constantly issue new debt to maintain operations, but the biggest buyers are leaving. For the past few decades, countries like China, Japan, and Saudi Arabia were the main buyers of U.S. debt, allowing the U.S. to maintain low interest rates. Now the situation has completely reversed. China is continuously reducing holdings, Japan's purchasing power is declining, and Saudi Arabia is starting to diversify. The proportion of U.S. debt held by foreign officials has dropped from 45% in 2014 to 28% in 2023. When buyers decrease, you must raise the price to attract new buyers. In the bond market, higher prices mean higher interest rates. This creates a debt interest rate death spiral. Rising interest rates lead to increased debt costs, requiring the issuance of more bonds, which requires higher interest rates to attract buyers, leading to further interest rate increases. U.S. debt maturing in 2025 reaches $9.2 trillion, accounting for 25.4% of total debt. If the interest rate on new debt is 2 percentage points higher than old debt, annual interest expenses will increase by an additional $184 billion. This interest rate sensitivity means the Federal Reserve's policy space is extremely limited. The result is a structural high interest rate environment. Mortgage rates remain high, corporate investment costs rise, and consumer credit becomes expensive. This is not a cyclical phenomenon, but the new normal. The U.S. economy will operate in a high interest rate environment for a long time. Central banks of the BRICS nations are teaching the whole world a lesson in risk management. Watch what they do. Do not listen to what they say. Their actions reveal the core principles of future wealth preservation. The first layer of defense is non-sovereign assets. Gold breaking through $4,800 is just the beginning. When the global monetary system restructures, the value of assets that do not rely on any government credit will continue to rise. Silver has also hit historical highs. Its dual attributes as an industrial metal and a monetary metal give it even more explosive potential. Physical precious metals are the ultimate safe haven assets. The second layer of defense is exposure to commodities and resources. If the global south controls most commodities, and these commodities are increasingly priced in non-dollar currencies, then holding commodity-producing companies is the best way to hedge against dollar depreciation. Hard assets like energy, agriculture, non-ferrous metals, and rare earths will be repriced. The third layer of defense is digital hedging. Bitcoin may be the only asset more portable than gold and scarcer than the dollar. It is a non-sovereign currency designed for the digital age. Although highly volatile, as a tool to hedge against systemic monetary risk, the logic for Bitcoin is becoming increasingly clear. The fourth layer of defense is skills and autonomy. In a world where global supply chains are being reorganized, the most valuable thing is the ability to reduce dependence. Localized production, practical skills, and community networks, these soft powers, are more reliable than financial assets during times of crisis. The key is to understand we are not preparing for a stock market correction, but for a restructuring of the monetary system. Such changes happen only once every few decades, but when they do, wealth distribution is completely reshuffled. We are standing at a historical turning point. Historians decades from now will define the 2020s as the beginning of the end of dollar hegemony. 2022 was the starting point of weaponization. 2025 is the turning point of acceleration, and 2026 may be the watershed moment. Every major transition in the monetary system is accompanied by a massive transfer of wealth. Those who see the changes in advance become the winners of the next era, while those who stick to the old models become historical footnotes. It took decades for the British pound to lose its reserve currency status, but once the process started, it was irreversible. Now, it is your turn to choose. Continue believing the old system will last forever, or prepare for the new reality. The central banks of the BRICS nations have already made their choice. They are not gambling. They are taking out insurance. The question is not whether change will come. Change has already begun. The question is whether you are ready. Because when the music stops completely, those who are unprepared will find themselves holding nothing but a pile of depreciating paper. And those who acted in advance will master true wealth in the new world. If this analysis has been helpful to you, Please be sure to subscribe to our channel and click the bell icon to turn on notifications. Tell me in the comments section, what do you think is the biggest risk in this financial revolution? How are you preparing to deal with it? Like and share this video to let more people understand this historical process that is changing the world. Your every interaction is our greatest support and the most powerful way to spread the truth.